vamos a reanudar los trabajos de la Junta para atender el próximo tema que tiene que ver con el Departamento de Finanzas y una serie de asuntos, empezando por la actualización de la política de inversión.
Correcto, at this moment we're going to conduct the meeting in English in order to be more comfortable. And we are going to begin with the finance department and the different points. And at this moment, Mr. Robert Longfield and Mr. Mike Portas. Longfield is the executive vice president and Portas is the senior vice president. And Carlos Negron and Roberto Miller are going to participate too. Then Mr. Robert Longfield is going to take in this moment the microphone.
Welcome. Thank you. Thank you. So we'll start off for the agenda on the investment portfolio results. Everyone should have a copy of the performance report. We have extra copies if you do not. It should be a bound copy. Oh, yes. Yes. September? Okay. September, yes. For September 30th purpose. Yes. So, a couple things. One, we've had a lot of money movements, market movements in the market. So you've seen the stock market was a bit more volatile in the third quarter. As you continue to see discussion on will the Fed cut rates, will they not? Fed did eventually move forward in October with the third rate cut of the year. Now the discussion is, will the Fed cut rates in December? Jerome Powell met today and sounded like he is less likely to have an interest rate cut in December. That's still likely, but that's been a big driver of market movements. And so what we'll look at is we'll talk briefly about performance, because I know we have a lot on the agenda. We'll talk briefly about performance. We're glad to go into any questions if anyone has them, but we'll keep our comments at a very high level. And then if people would like more detail, we'll come back to that. What I want to discuss first on performance is if you flip to page 1 of your report. On page 1, it shows compliance to investment policies. And what we have on page 1 is a couple things that are violations. 2 of those are totally addressed with the new investment policies that are being reviewed, and that's the maximum to high yield, which we've already discussed about that from an asset allocation. And then we have the old policies for plus or minus duration, and we said we didn't care, and we removed the minus, and that the managers can be more conservative, they just can't be more aggressive. We're okay if they want to be more conservative. So we took that lower duration band out. So those are the 2 items. If you see in red under violation, you see CDBCA violation of high yield securities at too high a percentage. And just for the newer members' benefit, when we had the trans notes in here, it wasn't in violation, but when those were taken off, went off to 0, all of a sudden our application grew because the total value came down so much. And then the 3.54 is the lower side of the benchmark, and we're slightly underneath that in duration interest rate risk. So that's more conservative. And that one,
Slightly underneath, what's the benchmark?
The benchmark is the U.S. aggregate, which is at 5.53, and we're
it's measured against a 5.53.
correct. Yes, sir. And so we're more than 25% shorter than the benchmark. And we're okay with it being shorter, just not okay with it being longer. More than 25% longer. So the one item that we need to address is the CDBCA investment. So this is a private equity investment that was made back in 2016. Your policies require, and the new policies still require, that all your managers be registered with the Securities Exchange Commission. This one particular private equity investment is not registered with the Securities Exchange Commission. So when we came on as investment consultant, we did a review of all the managers, and that was the one thing that we saw. We have had conversations with CDBCA. We have a letter that we can pass around that they issued from their attorney, basically stating why they don't have to be registered with the Securities Exchange Commission. We don't think that really changed intent. The problem is with the policies. The problem is this is a private equity investment that has a 10-year commitment, and you can't just easily exit this. So our recommendation is realizing that we agree with their attorneys that they're not legally required to have to be registered with the SEC because of their size. They're a relatively small money manager. They still, as I think Miles, they still have reporting requirements to the SEC.
Right, yeah, they have exempt reporting requirements to the SEC. They file a partial form ADD, so they are doing some reporting to the SEC.
Is it enough to appease investors' concerns about the use of the funds as they have indicated they will? I guess, not registered with the SEC. I guess that was probably perhaps something that was overlooked here, and the investment was made for whatever reason. I'm just always no. So it was discussed and allowed. I always have apprehensions about trying to justify violations to policies unless they have been well documented. Couldn't find any, documentation. We don't have any indication.
No, we will look further for that.
I asked them before the meeting, we were discussing this, Mr. President, and I asked them to look back to the 2016 decision of the board to justify, because it's not that it's a violation right now, it was a violation from the beginning. So if we can check and we're sure that there's a way that we can justify to keep it, there's no problem. But I don't want to go to a vote right now without.
Because if I hear you well, could there have been a legitimate reason as to why investing in a company that's deviated from that requirement, and what are the risks associated with investing in an entity that is not registered with the SEC?
No, and Miles is a big compliance officer, and he also has a certified fraud examiner designation. There are definitely, we prefer that, which is why it's in your policies as well. You generally want to prefer a manager that has to go registration. So we prefer that. I can only speculate as to why the decision was made. I know that investment was unique in that they made a series of private investments in Puerto Rico, but I don't know beyond that.
Yeah, I would add a couple comments too. I think registration will give the public, if you will, a greater level of transparency than non-registration, right? One of the points CDBCA made was that they are not providing investment advice to ICA, right? They're providing investment advice to the fund of which you are invested in. So I think, I'm assuming part of the argument back in 2016 is, we shouldn't be held to a registration standard because we're not even really providing investment advice. It's probably part of it.
So the decision could have been advanced under the notion of supporting certain, the investment strategy and the projects that they would invest in. You're saying that correcting that and getting ourselves out of that would come at a very high cost. Did I hear you right?
Yeah, there's really no way to exit the investment early because they're investing in private funds and private companies. You just can't sell those. They're in the secondary market. Yeah, correct. We could look for a secondary market for the entire interest, but the fund size is very small. It's only $45 million in total that they have. But they have one other Puerto Rico client here on the island, and that's pretty much.
Do we know what they have invested in?
We do. I don't have that in front of me, but I know they've invested in a few local, it's almost a fund of funds, so local private equity.
I'd be interested.
Yeah, you can bring that up. Yeah.
So is there any recommended courses of action on your part on that issue?
Yeah, no, on that issue, the only way to get it into compliance in my mind is for this committee to acknowledge that that's out, making a vote to make an exception. you CDBCA. Otherwise, it'll be a permanent policy violation for the life of that investment. Those are
I don't think we can, my immediate reaction, we don't have the elements
Yeah.
to normalize a violation.
Yeah.
Without knowing the circumstances under which they may have been allowed to be violated in the beginning, so, I guess the alternative is to
Keep it.
yes, to acknowledge that there are violations.
And right now, the note that I will put over there is that we are in an investigation to check how they did it in 2016 and see if we can keep that policy that they changed for that kind of thing.
So our
Yeah, we're gonna look into that. We're gonna do the research on the prior meetings and any documentation that we can get in order to get that straight, and we will send it to the enforcement.
and if we can find out the
The local investment that they have.
Yeah.
we will appreciate that.
We'll look at that.
So for now, we don't want to keep the note that we acknowledge
Yeah.
that there's something there that it's on the
And there is still an
investigation.
outstanding violation. Violation remains outstanding.
Okay. How much money is there?
5.7.
5.7 million.
Yes, and you committed a total of 10 million. So this is an investment that when they get underlying investments to make, they call the money, so they can call up to another $4 million. Yeah, 4.5.
And do you have how that increased, or it was 5.7 from the beginning and they
It was
haven't?
10, no, it was 10 from the beginning. And actually, to help you out, if you flip to page 51 in your report, you'll see where if you look at the contributions column, so you can see they made their first call in December, or these are by quarter, so it was in the fourth quarter of 2016.
Okay.
Made their second call in the second quarter of 17, and
And
then in the second quarter of this year, they made their third call.
What page is that, I'm sorry?
51.
51. They make 3 calls.
Yeah, they made 3 so far. But they have the ability to call all the way up to the full 10.
Okay.
Yeah, page 50 shows the summary, it shows the commitment, cumulative contributions.
Yeah, so yeah, if you look at
The page right.
Do they, do they periodically,
Yeah.
inform us?
Every quarter.
yeah, they send a statement.
I can send you a, PDF file of the last quarter.
And do we know what the performance of that investment has been?
Yeah, so the performance is down, yeah, it's right here on page 50.
Negativo en la
From inception, it's an annualized, they've lost money from inception, which isn't unusual for a private equity fund right at the beginning, but they've lost 4.4% annualized. So it's down about $300,000.
Okay. So we, I guess, take notice of that.
But we want to make sure we brought that to your attention.
Perfect.
Thank you.
That's what.
So if you flip to page 5, and I'll really just make a couple comments here, and then we can jump on to investment policies that we need to address. Page 5 is and 5 and 6 is the performance by each individual manager. Time doesn't allow for us to talk about each individual manager, but I do want to hit a couple highlights. If you look at the year-to-date column, so this is a calendar year. So for the 9 months ending September 30th, the total fund is up 10%. We're pleased with that number. It's in the top black lines. You see the gray line right below it. It excludes trans. So you can see, if you look at the 3-year, what effect the write-off of the trans had versus the rest of your investments. We want to show that separately because that was outside of your control as a committee. So, and you can see, the 3-year annualized number, excluding the trans notes, right down to 6.9% annualized.
The year-to-date excluding trans is 10%,
Yes.
and it drops down to 6.9.
No, I'm sorry. So if you look the first 2 lines there, the total fund, if you look at the 3-year number,
Yes,
you see the -6.5?
yes,
That's with the trans.
that's what
The number right below it is excluding the trans. And it made no difference in the quarter because we've already written them off. So the quarter return is or the year-to-date and quarter from the same. Next, if you look at total equities, so this is global equities, so both U.S. and international, for the year-to-date is up 17.3%, which has outperformed the index, which is the MSCI All Country World Index, up 16.2. So almost 1% of outperformance. The one manager I want to highlight in all your equities that's just done outstanding for the first 9 months is Atlantic Capital, and they're up almost 31% for the 9 months of the year. So that's a really great number. It's top quartile in the peer groups, way outperforming their benchmark. A couple managers have, are a little above. Actually, nobody's really much below. We got one that's maybe right at their index with Boston Common, but good performance across the equities. Total fixed income is up 7%, which not many people would have guessed this time last year that the bond market would be up 7% this time because everybody was seeing rates increase. Nobody was expecting the reverse in Fed policy. So that really happened, and we made 7%. Would have been more, but some of our international aspects drove us down a little bit. I'll talk about that. Santander's the only manager that's a little light this year. They were much shorter than their benchmark. They're up 5.6 versus their benchmark at 6.4. If you flip the page to page 6,
with the current interest rate situation, your recommendation on fixed investments, is that something that needs to be revisited, or?
No, sure, and we'll touch on asset allocation to refresh everybody's memory. But the big change we've made in that is we're recommending that we add a distressed debt manager. So that will look, if you start to have dislocations in the market, that will eventually come. These managers take advantage of that and can really pick up some distressed opportunities. So that's the one addition where we propose that we make into that. So we'll take some of our fixed income money and allocate to that aspect. That's what it will be the one change that we make. And the other thing, to the degree that the Fed is truly done with interest rate increases, which we don't think they're necessarily done. We do agree they probably won't cut in December. But most of your managers have a little bit shorter duration than the benchmark. So that's been a little bit struggle this year. Some of them have trailed a little bit. But if we do get a reversal where Fed starts raising rates, they'll outperform in that scenario. So then if you look at alternatives, our total hedge funds were up almost 10% year to date. That was led by X Square, which had a really tough year last year, but it's up over 25% this year. Also, Palladium is up almost 10%. They've done very good. Pluscos has been the one manager that's had really light performance. And again, I'm on page 6. If you look at the Pluscos fund, they're only up 3%. Their benchmark several percent higher. They've been consistently under for the 1 to 3 year period. Then we have the three, on the private real estate side and the private equity. Look at page 7, and we have the detail on those managers. Those don't update as rapidly. So I want to comment, Invesco is a private real estate fund that you've had since 2008, that its final payment to you this last quarter, and so it paid out. You made almost $2 million on that investment. Annualized return at 6.86%. So it was a solid investment considering it started out in the bear market period of 2008. Then you have your 3 private equity investments. These are ones that include CDBCA. You see the commitment amount for each of these. The Grupo Guacon, CDBCA, and Advent Morrow Fund 3. You can see the money they've called so far. Most of them are too early to say whether they're good or bad, but I will say Grupo Guacon is starting out very well for you, up almost 10%. This early, very good. We're very pleased with how that fund performed. The other 2 were, again, they're early to get too uptight, and Advent Morrow is called hardly any money, so that's yet to be determined, but it's largely just fees hitting so far on those.
This CDBCA, Puerto Rico Fund for Growth.
Yes.
So is that,
So let's go on.
Yeah. And it only invests in private equity opportunities here in Puerto Rico. And the last page I'll refer to is page 10. Just for the quarter, we were up 1% for the quarter, but I think it helps to put it in perspective of actual dollars. So if you look in the net investment change column on page 10, in the black line there at the bottom, for the quarter, you made $1.18 million. So yeah, we still made a little over $1 million, even though we would like to see a little bit better than 1%. The market didn't give it to us this quarter. But so far in October, we're probably up about that much just in the month of October.
Okay.
So we're probably up over another $1 million in the month of October. So for the new fiscal year, we're up a little over $2 million so far, and maybe more in November. So because of time, that's all the prepared comments I have.
Just no more than 10 seconds. Your general outlook for the market for the next year. Should we be anxious, apprehensive?
Bumpy, I think, is what our outlook, but we're very much in the slow growth camp. We don't see any reason for a major recession. We think the White House is going to do everything possible to keep that from going on in the election year. And so we think from that standpoint, you are seeing some softening in the trade negotiations with China. The Fed still, even though they're saying they may be on the sidelines, their net bias is going to be accommodative if they see the numbers get weak. So from that standpoint, we think positive markets. We don't think big positive. Not a year like this year that we'll see another 20% stock market. We don't expect that. But we do think we'll likely see positive numbers. That doesn't mean we might not see a drawdown, 10% correction and then it pick back up. But we think net positive on both the stock market and bond market. The harder call is where the U.S. dollar is going to go, and that's the one that we're really struggling with a little bit more. We're going to see some continued dollar strength, or is it going to stabilize? We don't necessarily expect we'll see a lot of weakness in the dollar. The next item, if no further questions on performance, the next item is investment policies. So if you recall, at the last meeting we attended with you, we had prepared a draft of the investment policies, and we went through the asset allocation which you approved, and I'll talk about that as well. But at the same time, like the week before, FOF had just come out with their new guidelines, I believe it was in February of this year, that they issued to all the agencies to make sure certain things were included in the investment policies. So with the prior committee member, Manuel Gonzalez, who's from FOF, ourselves, we went through, we read through the policies, we created a draft, went over that with Manuel Gonzalez, and then we had a conference call with Jesus Matea, who's the one that wrote those investment policies with the FOF. We all three collectively went through this latest draft. Everybody was comfortable that we incorporated all the items from FOF in here, and that's what the document that you have here with this latest draft of statement of investment policy objectives and guidelines. Run through. I know we went through a lot of the items. Let's see, I believe you have a final copy. I do have a red line copy, but the main changes, and I'll touch on just the main changes from the earlier draft that you'd already seen. From the earlier draft, you'd already seen where we've changed references to the Government Development Bank and replaced those with a FOF as appropriate throughout. So we did that and changed some of the actual authorization acts and references that went with those. We also clarified the name of the Audit and Investment Committee to just the Investment Committee. So we did a few superficial changes like that are what is currently being acted upon, how things are currently being labeled. We added a few responsibilities that were specific. They wanted every committee, and this was a change that FOF had, to designate to designate an investment officer, which we labeled that by position, and that the executive director designates an investment officer. We have designed what we fall into Carlos's duties and responsibilities, and we label that. You'll see in section 4, I believe it's page 6 of the report. Yes. No, I'm sorry. It's page 5. Page 5, section 4, responsibilities of the executive director were already there, but responsibilities of the investment officer. So that section is new, and still really just the day-to-day responsibilities of an investment officer, which is already being practiced. So that was a change to that. The other change that from the AFOP guidelines that we hadn't already talked about,
Did I thought look at this in its final draft?
that was the call we had with Jesus Mateo.
Okay.
Yes.
They did something true, thoroughly, quite.
It has this blessing.
Yes, he was very comfortable with the document. Let's see, I think all the rest of them were ones that we discussed at the last meeting where we talked about changes. The biggest change is the asset allocation changes, which were per the study that we conducted, and those are on page 13. The new policies there. The biggest aspect of that on page 13 was to extract the trains notes out of that. If you had a target allocation of a third of the portfolio in the trains notes, so we had to pull that out and basically put it back in the fixed income.
What was the trans investment amount?
$50 million.
So it was a large allocation. So, and again, in the policies here, there were a couple other clarification items. But again, I believe all those we discussed at length last time, just clarifying the benchmarks. We simplified the evaluation criteria for managers because, and made it something that we can easily build into the performance report. So one thing that we're very strong about is if you have investment policies, make sure you document that you're in compliance with those. So we try and get everything that we can build it into the report. So in your quarterly report, it'll clearly show if there's any policy violations. So that's the changes we made, were just some of the metrics to make sure those things can be documented. But I'll refer to page 13 in your report. I just want to make sure that there's no additional questions on the asset allocation. So before you go into a vote on these investment policies, if I can touch on the next agenda item, which was, you should have a copy of this green report in your handouts. If not, we have extra copies. It says, as automobile asset allocation studies that we presented back in March. So this was what the committee approved back in March. So what you see is if you flip to page 9, this report, the numbers are in green, kind of on the bottom right. It says current and recommended portfolios. So you see the current was back at the end of February, and the recommended targets. So what this did is move the targets, and those targets comply to what's shown on page 13 in your new report. We adjusted some of the mins and maxes to go along with those rough targets. So the page on page 9 goes into a little bit more detail because we show the difference between small cap and large cap, where here we just show total equities in this report. But basically you can see the change. The net target is very little as far as equities. US or total equities went from 20 to 21. Non-US equities, you see a 13% target. It had been at 15, so that's actually a little lower. We increased non-US equities from 5 to 8. Fixed income actually came down a little bit.
Let me make sure I'm following you. The lower limit in the target allocation of 21 compares on the March with the small caps, large caps, equity, and international equity.
Yes, sir. And emerging markets equity.
Emerging markets equity. From 29 to 21.
As far as from the existing allocation.
Oh, that's,
The previous target, you don't have that in front of you.
recommended target on page 9, I think.
I'm sorry, you do have it in your quarterly report, if you want to see what the previous targets were. If you flip to page 2 of your report, you know, of the balance, the spiral balance. If you flip to page 2,
Okay.
you see that column in the middle, or,
Returns?
no, not, well, current is where you are, but your old policy was right there in the next to the current, where it says 20% for listed equities. Okay, that was what your old was. And so if you look at
So
that,
you're moving to 21.
yes, sir.
Okay.
And then if you see,
Fixed income
yeah, it's going from 31,
to 54.
well, but it was a combination of the trans and the fixed income. So it was at 65,
Oh, okay. It was 65.
yes,
From 64, so you're coming down to 54 from 65.
yes, sir. And so a little bit of increase in alternatives. We're going from, it was 14, and we're going to 15 and a half. The big change is private equity. It was at 1, and that's because the prior group, the prior committee committed all those to CDBCA and all those, so it's
So
going
the
to grow
7 basically is a reflection of where we are right now.
but with the commitment. If it was all fully called, yeah,
So,
exactly.
so it's not necessarily because you would have recommended that, you're just, it's an acknowledgement of where we are.
Yes,
So I think it is important we highlight that in the minutes, just to make sure that, you know, if somebody at any point in time questions private equity on a public fund at 7%,
Yeah.
that may be construed, I don't know what it is on other public corporations, that's too high. Well, it's not that we put it there, it's that we,
It's a combination of the loss of the trust plus the commitment is just increased like substantially the.
but yeah, if you still had that 50 million there, it would be that large. That was written off.
right, no, that I understand, the fixed income modification, but the increase in private equity is just a reflection of where we are right now. But you feel comfortable in recommending a continuation of 7%, as opposed to being 4 and we're at 7 only because we committed to a $10 million
And a 10-year commitment.
and a 10-year commitment. So your recommendation would probably be lower than that?
For this pool, you know, we probably only did about 5, so that's a little on the high side. We don't think it's out of range, but it's a little on the high side.
Okay, so we can make a note of that.
Yeah.
That, you know, it is where it is because, you know, a decision, an investment decision has been previously made that puts us there.
Yes, sir.
And your recommendation, it's on the high side. We would like to see it a little lower, but it's difficult to get it down to where I think it should be, only because we're high.
Yes.
Okay.
And then the other thing is we had a 0% cash position with rates, with cash rates so close to what bond rates are, we recommend them keep 2% in cash. So we were at 0, we're recommending 2. And so that's the changes that you're adopting on those. It was discussed and approved last year. And back to page 9 on here, to refresh everybody's memory as to why. We said if you just took your current allocation with where you were based on our outlook on markets, we thought that would earn about 5.3%. We think the new mix will earn, once it gets fully implemented, will earn right 6.1. So we think it'll pick up, and we also, the standard deviation is how we define risk, which is volatility, how much it bounces around. We actually think this new mix will actually be a little less volatile than your current mix. The main reason is we're taking some off equity, which are much more volatile. And improve Sharpe ratio. It graphically shows it on page 8. Previously, it's the current allocation and the proposed of 2 squares. So it moves up in return and a little less risk. So I can go into more detail if people would like that, but we're asking for approval of these investment policies to comply with the top guidelines and other changes that need to occur.
The finance department feel comfortable, I presume you have looked at this in more detail? Yes.
We
And
have.
I'm ready to recommend that.
Absolutely. Moción para que se apruebe entonces los cambios y la nueva política.
Approved.
Now, I believe, so we had two more things to discuss. One is Northern Trust. Northern Trust is your custodial bank. They have maintained the current contract level for a number of years. They are, in their contract renewal, they are proposing an increase of fee by an additional $20,000.
From
From 80,000 to 100,000. So,
25%.
yes. What we have discussed with them and negotiated with them is,
We should have that. It's,
yeah,
2000 was, 12, it was 2012 that it was increased from, and partly it was because we terminated the security lending program. It went from 60 to 80.
okay. Yeah. and
60 to 80, when?
2012.
And that was basically because we terminated the security lending program. That was bargain and the Lehman Brothers problem. We experienced some issues with that program. And the board decided at that time that we didn't want to take part of that. And that's why there was an increase in the fees.
And so what we have discussed with them is if we were willing to look at them for commission recapture, which is just to the degree managers can trade through them, they can capture some of that commissions and rebate it back to us. It's just at the manager's discretion when it makes sense. If we put that program in with Northern Trust and we put in a program to go back and include the securities lending, they'll keep the fee at $80,000. So, and which is our recommendation, is that we do that. And let me explain a couple of things on that program. So first, securities lending, a lot of the large custodial banks had a problem with securities lending in 2008 and 9. That's because when Lehman Brothers defaulted, a lot of times Lehman Brothers was coming up other side of the collateral on some of that. So when security goes on loan, somebody has to put up collateral more than the value of the security that was borrowed. This is all behind the scenes, and the bank, custodial bank handles all this.
I mean, conceptually, it sounds like securities lending, are they using our securities to collateralize their transactions, which earn them?
Yes, but they split all that income with us. So the first question I said is, all right, give me an understanding of how much income the fund would make if we participated back again in the securities lending program. They did a review of your investments, and they said it probably would earn about another $50,000, but you split that with the custodian bank.
That's how they make the.
Yeah, so they'll make about 25, you make additional 25. That's
But their return on investments is infinite, our return on investment is.
It's the same, because if someone borrows a security out of your portfolio, you get treasuries usually, or money market instruments that collateralize that. If the manager wants to sell it tomorrow, they call it back immediately. So it doesn't disrupt your program. So if you think, I've got an asset just sitting there, they're taking that asset and earning a little bit more money for you. So because they're doing the work, they get half of it, you get half of it. So on that, you'll earn $25,000. The concern that happened,
And they invest in treasury?
short term, so it can be repurchase agreements, it can be treasury, it can be money markets.
So they investment grade?
Yes. So, and that's the other thing that's changed since 2008, or since they had this problem. So since 2010, 11. Is that
financial collapse? It was not a
Yes.
problem.
But they got more conservative on what they invest that collateral in. So that was the problem. So it's just super conservative investments. So that makes the odds of, if you had a 2008 again, it's very unlikely that you would see this problem occur that happened in 2008. And at the end of the day, you didn't lose money. You got a paper loss for a little while. But at the end of the day, the bank paid whatever loss was really there. So that was what happened in the prior experience. But it caused some headache for a couple of years there as they were working through that loss. But our recommendation is
the worst case scenario, we do that. It's really, and collateralize their investment in investment grade security short term. The worst case, if what they're using as collateral would be what, equities or?
Oh, no, it's all short-term fixed income instruments. Money market is short-term fixed income.
So collateral, they could call for more collateral if rates increase from 2 to 9 in a day, the value would collapse and they would.
But more realistically, it would be a situation that, let's say, Miles was the other side of the transaction, and so he borrowed a security from Northern Trust that came out of your account. The stock price shoots up on that security. He has to put in more collateral. He doesn't put in more collateral because if the price goes down on the security, he's able to reduce collateral, or if he defaults at that point, you have more than enough collateral sitting there. So it's a situation, generally, if the market's going up, it's the odds of him not having the ability to fully collateralize it because the price is going up is rare. So that was a unique situation where it was a collateral that was put in there drops faster than the security he was holding. And that's because it was a credit-led crisis. So those credits dropped quicker than some of the equities did initially in that, and that's what led to the problem in securities. And now they don't take as much in corporate credits, and they have higher credit quality standards. So it's it's a lot of treasuries, but it's a lot more treasuries and agencies that they use as that collateral.
And how much, what would the exposure be, just enough for them to make roughly that $20,000 additional dollars?
Yeah.
Which wouldn't,
And they have to, and the position when the borrow is over collateralized, so it's like 102%. So if it's a $100 security, they have to put $102 in for every share they have.
but I mean, how much of the portfolio could be set aside as collateral to undertake this program? Just a little tiny bit.
Yeah, it's, I didn't get the exact percentage that would generate that, but I would think it would be definitely less than 20%, maybe only 15% of the portfolio. And it could even be less than that, because the only things that are eligible are where you have separate account managers. So if it's anything that's in a mutual fund or a commingled fund of some sort of partnership, that's not eligible. It's only where you have, and the main thing that puts a lot of collateral is actually your bond portfolios. So your high grade bond portfolios, again, there's really less risk on that piece of the portfolio as well. So it's,
So your recommendation?
our recommendation is that we accept the proposed contract where we maintain the fee at 80 as opposed to moving to 100,000. Realizing we'll save $20,000 there, and realizing we'll probably pick up an additional 20 to 25,000 in securities income. So net it's about $40,000 to $45,000 in savings. We think that's worthwhile to pursue that.
But the price for that is to allow them use 15% of your investment portfolio as collateral for these types of investments, if I hear you.
It's loaning it out, and it's not a set percentage.
Not just to have a.
Yeah, but some portion of the portfolio that could be allowed to have stocks or bonds used to borrow. Other people put in collateral, they borrow, or we basically have to borrow.
Against
Against
the collateral.
Yep.
But it would be tied.
Correct.
And you can exit that at any time, and if you do, I guess you would be responsible for the $20,000.
Well, the contract, they would have to come back and renegotiate the contract, so at that point, but yes.
And it's gonna be a year-by-year commitment.
Yeah, and we'll look at the actual contract terms, but I'm sure we can exit that program sooner if we want to. But yes, so the contract term, I don't remember what they had proposed on that. I don't know if y'all do it. If it was a multi-year.
This is like a bank contract.
But
Well, it doesn't have.
it has cancellation provision in it, so it can be canceled.
Carlos, I think it's gonna be appropriate you explain. Carlos and Carlos.
Sure, regarding this, we have been really strained on the operational budget side specific for the services charges that we have for this year. And it's something that has been really difficult for us to get the funding and to get increases on the operational side. So that's why we're looking for like new ways to get like the cost constraints and being able to generate a little bit of money into that. So I just wanted to get that point into discussion that it is, we're in a position right now that we have to ask if we have to reallocate the funds. It's just a process that takes time and it's difficult in order to justify it and have it in place. So
So your recommendation
that
is
being
also-
said, so my recommendation into that is to adhere into the security netting program in order to be able to maintain the current expense trend. And since it's a way that you can easily terminate, and the past experiences has been bad in terms of what just Robert explained, the outcome, the final outcome of it didn't impact the ARCA, so it's something that we still have not like experience into our books that we had to pay the loss of the PAC program, so it's something that we should also consider into getting into place so to maintain our costs.
So another way of looking at it is to try to leverage the asset base to increase the yield.
That's exactly right. That's a great summary. That's all it does, in fact, is pay a little bit of interest.
Is this consistent with the investment policy?
It is. Yeah, actually, the investment policy is relatively silent on securities lending. But
Should it be?
Most of my clients do not have policies on that. They leave that up to kind of the individual contract negotiations with the custodian.
Because in theory, you're extracting more value of your asset base, but you're also increasing its exposure.
Slightly, yes, sir.
No, I just,
Yeah.
I know that it from all the angles.
Yeah.
You recommend it?
I understand that we are in a place right now that, taking into consideration the past experience and the fiscal position that we are right now, it is important to us to be able to leverage on this type of transaction in order for us to maintain a stable operation in terms of fiscal policy.
Two more questions. It's obvious. I mean, it doesn't even begin to compare to our trends. And two, I guess the Northern Investments a request for a 25% increase in their yearly fee. Is it reasonable? Is it in line with what is happening? Are they running the?
If the committee doesn't accept this proposal, because I think this proposal is reasonable, keep it 80,000 and security lending. If they didn't, our recommendation would be that you do an RFP. I think the 100,000 seems a little high. It's not way out of the ballpark, but it seems a little high. And I would think it would make sense if you didn't accept this proposal to.
Well, because it's year by year, then we can accept for this year and call for our RFP.
Yeah.
We can do both. We can commit for a year and ask for our RFP.
Because
You can look for the RFP in the process of the year too, if you.
Of course.
Deeper, so move it along that way.
I mean, as long as we understand that we're making an investment decision to increase the yield of the asset portfolio, which is good, at a little bit more risk, depending on what happens, perhaps we may want to start thinking about an RFP for the next year.
I think we can do both.
That's something we're
Okay.
So, moción para que se apruebe el contrato ¿cómo que se llama? Con el Banco Custodio. Y entonces pedimos que se abra el proceso de RFP para el próximo año. Tomar la revisión año a año. Ok. Segunda dos.
Sí, no hay opción.
Hay revisión. Aprobado. Okay, we approve on that.
Okay.
But we are looking to them for RFP.
Okay.
next year.
It's a way to put some pressure also.
All right. And I think that's good. We'll have a sense of how much is being generated with the program as well. The last item is to implement the new investment allocation that we approved. It would result in 4 manager searches. So those are, let's see. That would be for a new emerging markets equity manager, a new emerging markets debt manager, a new distressed debt manager, and another private real estate manager. As ours is payoff, the investor payoff is still like that space. I have a couple questions on, basically we're asking for permission to proceed ahead with those or with those searches. But I do have a question for the committee if everybody wants us to move forward to begin those searches. So we
Why?
can.
Why the searches? Why?
So
Is this to replace?
some will be replaced, some will just to get to the new asset allocation. So we don't have a private real estate manager, and we don't have a distressed debt manager currently. And those are two new areas that we approved.
Private real estate and distressed market.
Yeah, distressed debt, so it's kind of high yield distressed high yield. Yeah.
That's new. Private real estate, that's new.
Yes.
If you look at page 9 in the green book, you'll see it's got your current and recommended portfolios, and it's got an asset classes that have zeros.
So, page 9. So, yes. So if you start at the top, you see emerging market bonds. We have 3% currently. We're going to 8%. We think we definitely need to add another manager in that space. If you look at emerging market equity, we think we ought to consider possibly a different manager. We've had mixed performance out of the existing manager, so we want to look at that. That's not at the top of the list of the priority that we do these. And then if you look at distressed debt fixed income, we have 0 there. We're recommending 10%, or what was approved was 10%, so we need to hire a manager in that space. And private real estate, Invesco was paid off, and we're recommending 7.5% in private real estate, so we need to do a search there. So those are the 4 categories that we need to do to implement the strategy, and we're just looking for approval to begin that process. And once we begin that process, we do have a question on how we would move forward. And so we
First, we authorize the search.
That's the first part. The second one is, I think we are to comply to the policy that the asset allocation that we have already approved. We should start that. That's the next step in order to comply with the asset allocation.
Again, the question they're looking for, the answer they're looking for is they're beginning to do a search. Once they select a couple of managers, would you like them to interview them yourself, or should you accept a written recommendation, or you would like to meet this new group?
¿Cómo se ha hecho el servicio?
Se ha hecho de distinta manera. A veces se ha traído el grupo, a varios grupos. Y la organización de educación.
Si nos hacen una presentación de cualificaciones de los 2 o 3 que yo le llamo, y con una recomendación, entrevistamos que ellos recomienden y que ustedes también los 3 recomienden también. Eso es una recomendación escrita de 2 o 3 o 4 candidatos, una tabla que compare las capacidades, las experiencias, la trayectoria, con una recomendación que ustedes entrevisten, se sienten cómodos con ellos, vamos a ver para entrevista y aprobar.
Tenemos los top 2, top 3.
¿Qué tú recomiendas?
Top 2.
you'll need to give them 30 minutes apiece to interview. So that's
Top 2 of each one.
I guess what we're suggesting, sorry for our language. Yeah, I'll have to change. Perhaps if you can do a search and identify amongst 3 or 4 or 5, however number you feel, and if you can make a recommendation, a little matrix on each, identify capabilities and trajectory, cost, and maybe the finished department can interview two, and then recommend them to us. We'll do the other presentations and finally decide based on your recommendation.
Okay. So we'll work with finance and we'll prioritize, since we're moving, more money is going to be moving kind of into fixed because of the trends, we're underweight there. We'll start with the distressed debt and emerging market bonds first, and then we'll do the equities after that. Sure. We'll deal with those two.
Because those are new.
Yeah.
Moción.
Moción para que entonces procedamos a la búsqueda y a que se nos presenten los sectores para entonces ser presentados la evolución.
I guess we're now, thank you very much for the
Thank you.
presentation, and we'll see you all now. Go ahead.
Bueno, señor presidente. Pues terminados los asuntos medulares que están en la agenda, moción para dar por terminada la reunión ordinaria del día de hoy.
No habiendo objeción y habiéndose tratado exitosamente todos los puntos de la agenda, pues damos por terminada la reunión ordinaria a las 2:59 de la tarde del 13 de noviembre. Muchas gracias.